Good morning and welcome to the Orlando Real Estate Buzz. I'm Brendan Rendo with the Homes Orlando team and joined by Joseph Dionne of Aptly Home Loans. We've got a lot to go over today. It looks like we hit Labor Day, got through it, and the news just started cranking. So good stuff, some what's going on stuff, and we'll kind of get into all of it today, but we want to start off with some good news, which is mortgage rates are finally seeing some relief for buyers. So we're going to take a little look at that, Joe. Is that all right?
I think we can today.
All right. Well, welcome. And this is the Orlando Real Estate Buzz. So let's hop in right with the good news, which is interest rates dropping. We've seen it, on the news of the jobless claims.
Mm-hmm.
That it's forced interest rates with the anticipation of what the Fed is going to do, which is great. I mean, it's nice to feel some relief for a lot of buyers. Where are you seeing your rates right now, both conventional, FHA?
Yeah, we're talking over the last 30 days, or really like 2.5 weeks. We just saw kind of the market. We knew we had the expectation, but then you see kind of like, all right, well, are the Fed's going to drop the rates in September, which that's like next week.
Yeah,
so then you see some data, and I'm sure we're going to talk about a lot of this stuff, like some revisions that happened that were like mind blowing. But it really caused the 10-year to drop, caused MBS to go up, it means lower rates for everybody without getting too technical. So we've seen rates drop between, let's say 0.75% in the last 2 weeks, which is huge. 2 weeks to 3 weeks. So you've got a lot of clients that maybe they were looking at a 6.9, somewhere around there. Down to now they might be looking at a 6.25. We might be looking at, some clients might be looking at a 5.99 for some clients, maybe with a little bit of a buy down on conventional.
Wow.
And FHA
it's been a while since we've seen something break below that 6%.
So funny enough, it's been almost a year. Like we just touched it briefly last year. Very similar setup. But what does that look like for a client? You're talking right now, let's say a $400,000 loan. We're talking about $200 in savings on that principal and interest payment between what they could get a month ago to what they can get now, which if we take $200 in monthly savings, we're talking that could be $40,000 in buying power. Buying power, 40, maybe 50 additional, like somewhere in that range. That's a big difference. Like that's either savings or more buying power. And I think right now, you're going to see more clients are going to sit there and just take a breath of fresh air and be like, okay, I can afford more. Like I can have a more comfortable payment.
Yeah, I'm not. It doesn't sound like a lot, but that $2,400 a year, it's a good savings overall for people.
Yeah, I mean $200. Like we used to say that's a car payment. We don't say that anymore.
Can't say that anymore.
But
it's what, 2 dinners out?
One nice dinner.
One nice dinner.
But it is very, very interesting to see that kind of happen. And and I don't want to kind of but you and I kind of had a lot of conversations about this last year. Does the move come too early? Does it come too big? We're having the same concerns this year, because last year we hit some of the lowest rates, and then all of a sudden they spiked again in the last 60 days of the year.
Yep. Yeah. I mean, when we look at it, at what's going on, is probably one of the biggest things was the revision to the jobs number.
Yeah.
Which from March of 2024 to March of 2025, they revised it down 911,000 jobs. That's a lot of jobs. And my question, we were talking this morning, was if if we had seen actual real numbers during the year that lined up with the revisions, why would we not have seen a reduction in the Fed rate earlier? I think we may have seen it possibly 6 months earlier
Yeah.
because inflation rate had actually dropped. And when we look at some of the charts today, you look at it, and here's, we got the initial jobless claims come out today, and you see that, we spiked to 263,000 jobless claims.
I think they were saying this was the biggest initial since October of 21.
Yes. Yep.
So it's like almost 5 months or 4 years, excuse me.
4 years. So you've got the revision down, you got employment claims going up, and you look at the overall unemployment rate, and you see here, if the jobs numbers have been different, look at this. You had a 4% at the end of, for total of 2025.
Mhm.
We were at about 4.1, 4.2. And then you come in and you look at where the inflation rate was back then at 2.4.
Mhm.
I think when you looked at that, you had a solid unemployment rate at 4, inflation at 2.4. I think the Fed would have cut a quarter point back in February or March if the numbers had been correct.
It's so tough to look. I think you're right, but I without getting too much into it, I think the number, like, you get the sense like you don't see a million reduction or revision, like 900,000 revision unintentionally in my mind. So I'm like,
Yeah.
it's like, I don't think the government was ever that far off. I just think that they probably had ulterior motives and knew not, like, I don't know. I could be wrong on some of this, like, but it's very hard to believe that they were that far off. And if they were, like, how do we fix this? Because this is going to be a problem. Like, what are they going to come back next year and go, hey, like, we thought we created 800,000 jobs, but we really created 2 million jobs. And then it changes everything again.
It changes everything again. And you look at, the firing of the labor statistics per, head. I get it. I mean, I fire them too. I mean, you're looking at these numbers. These numbers are used by the Fed, used by Wall Street, used by people to try and figure out how to invest, where to invest, how to make monetary policy.
Yeah.
And you're making monetary policy off of false numbers, false assumptions.
Mm-hmm.
And that's really the hardest part. But what is it doing now is, we go in and we look at the Fed overall, here it is, what people are forecasting right now is, we're definitely getting the quarter point rate cut.
Yeah.
September. It's done. But look at this, October, 80% feel that we're going to get another quarter point. December, we're going to get another quarter point. January, about 50-50 that we're going to get another quarter point.
That's to be like, I can't see 4 back to back to back. I just can't.
You drop rates when the economy is bad.
Yeah.
And to me, I mean, you feel the tension, and there's been a lot of tension in the economy. Talking to clients, working with clients on an everyday basis, you feel a lot of that tension.
Yeah.
And a lot of that anxiety. Rates have gotten a lot better, but now I'm kind of worried about, will I have a job?
Mm-hmm.
So it's shifted from now the rates to job security. But at the same time, I just feel like in the past month, everyone has totally thrown inflation out the window.
Yeah. That
the Fed, who had this goal of a 2% inflation rate, and we got the number in today, and we're at a 0.4%, which translates into 2.9% for the year.
Yep.
It's well above what the Fed has been shooting for. And when you look at inflation over this year right now, look at this. We've really, April we hit our low, 2.3 percent. And since April, we have continually climbed up on the inflation rate.
Mm-hmm.
To where we're sitting at 2.9. So what happened to holding the rates to keep inflation down? I know your dual mandate is employment, inflation. And what is it
Trump's mandate? Housing.
But what?
I'm not crying about that.
Yeah, they're not crying about that. What is it that shifted the balance from inflation and jobs to jobs and what was that other thing you're supposed to mandate on? It really seems like it's just kind of gone out the window for them. That all of a sudden inflation is just it. What is that? Well, they literally said we're throwing out the average.
Yeah. Well, is it a we've talked about this a lot over the last, you and I and all these lives is like, are we kind of operating as the best of the everybody else? Like, meaning we start looking at everything and we see all these other countries are cutting, or we see this and stuff like that. And we go, well, we're a little bit better than them. Like,
oh my gosh. Yeah.
And now it's like, all right, well, even if inflation gets here, like it's still better than them. Like, and they're not wrong, but is that what we really want?
Turkey's inflation rate came out at 33%.
That's
33%.
Hall of Fame numbers right there.
Yeah. And what's amazing is their central bank continues to cut rates.
That person needs to be fired.
He's fired like 4 of them in like 2 years.
Oh my gosh.
It's like he fired 4 of them in 2 years. It's like, guys, it's not working. Whatever you're trying is not working.
Well, and I look at a lot of what we see, and it's hard not to get excited. Where you're a realtor, I'm in mortgages. We love interest rates going down. Fed fund rate's going to have one thing I always tell everybody is like, when the Fed rate drops next, when it actually drops, like interest rates, we've already on mortgage side, we've already factored it, right? Like we probably with this movement, there's potentially, we are already factoring 3 rate cuts. So we find out it's 2, rates might actually get worse. So the funny part about that is it's hard not to be excited to take advantage of this. We're definitely going to see applications go up. Like people are people calling me. We're calling a lot of our clients because that whole synopsis of what was the phrase that every realtor preached for like 3 years? Date the rate.
Marry the house, date the rate. Date the rate.
And it's like, it's something I've never really talked about because, it's like, you don't know when. Well, now there's finally an opportunity that people are able to get. And here's the funny part. And we don't know if it's going to be long-standing. We don't know if rates are going to keep coming down. We have an idea and this and that. But it's so funny because I'm starting to see clients that have been at 7.5, that they're sitting there now going. And I talked to someone the other day, they're at a 6.99. They've been in their home for 2 years. We reviewed the numbers. We looked at it. I was going to get them down to 5.625. It's huge for them. They were going to buy down the rate a little bit. It was great for them. Almost $600,000 loan, massive. It was going to be massive savings for them. We're talking over $400 a month. And they were like, I think rates are going to 5s, low 5s. I'm going to hold off. And I'm sitting there going, we're over a percentage point lower on a $600,000. You want to gamble and wait? What? And I was like, what if it goes back up? We don't like, this is the opportunity. Like, let's make sure we can always look down the road, but like, why not get that savings? And I'm doing the analysis and I'm talking about, well, if we took the money and you just applied it, this is how much faster you would pay off the mortgage. We're not going to add any time. We'll do a 28-year term versus a 30-year term. Hey, we can do this. And, like, I was laughing because in their situation, their recoup for the refinance was 23 months.
That's
they were
good.
like, that's just too long of a recoup. And I'm sitting there and I was blown away. And I think, like, the challenge that we're going to have right now is now you're going to get a lot of this. We ran into this when rates got into the low threes and the high twos. People thought it was going to keep going lower. And then they missed an opportunity. Like, I don't know if this is going to last, but, hopefully we stay in this range. Like we've said this before, that the 5s to like that 5 to 6 is like where we think a balanced marketplace should probably be. But if we don't stay here, there's going to be a lot of people that miss an opportunity, either purchase or refi, because of so many other uncertainties and so much thing drawing out their attention. But then on the flip side is, what if everybody takes advantage? It spurs the economy too much, and then we have to push things up to slow everything down again.
Yeah. It really is a dichotomy of questions that no one really has the answers to. I mean, we can sit there and, you and I are, study this all the time. And you go back, you look historically at different things as well. One thing I look back at is, the years of stagflation that we had. I don't think you were quite thought of yet, but I remember living through the 70s. And you look at it, and this is stagflation, is you have a high unemployment, high inflation rate. You've got a double whammy all, through the entire 70s. I remember everyone being stressed, parents, everybody just seemed like they were stressed, during the 70s and stuff. And what happened is Reagan's head of the Fed came in, pushed rates up to try and stop the inflation that was going on. And then said, okay, well, we'll drop rates. And what happened? We got a double whammy, is they dropped the rates, but then inflation shot right back up.
Yep.
So what did they have to do? They actually had to take rates even higher to push the rates back down. And that's my concern right now, is you see where, when you go back, when we look at the inflation chart again, is what's happened. We're spiking, we come down, and we're starting to spike again. And that's a cycle I don't think we want to continually get into.
Yeah.
Because you can't, when you look, I look at what's going on in Europe, where they've cut their central bank rate numerous times, and all their bond yields have actually skyrocketed, gone up like a point and a half, but because of their debt problems, which is the problem we have.
Yep.
Because there's the one thing we didn't have in the 70s is the federal budget deficits that we currently have.
Yep.
And that's the thing that's my biggest fear, is we're going to hit that wall with the debt, with what needs to be refinanced, and we're not going to be able to do it. And we're going to be putting trillions of dollars out there to be repurchased, refinanced, and people will say, no, I don't want it. I don't want it at 4%. I want it at 5%. Yeah, because we've seen the 30-year Treasury spike up to near 5%.
Yeah,
a couple of times within the past 2 weeks. So there's a lot of dichotomy. It's just you don't know which way it's going to go and what's going to push it. So when you have that window, it's like anything. When you have that window, trying to have that crystal ball. But if you and I had crystal balls, boy, we wouldn't be sitting here today.
Yeah, for sure.
But I also know, but sometimes there's analysis through paralysis, or paralysis through analysis, excuse me. And I think that's what a lot of buyers, a lot of homeowners get into.
Yeah.
And sometimes just, you know what, maybe I am just better off pulling that trigger. Like, to me, I think that's a great scenario for your client. I mean, 23 months for a refund to recapture your money from a refinance. That's fantastic.
Yeah,
That's a
I,
great
I,
window.
I typically my number is 3 years. If you can recapture in 3 years, it makes sense. Like
Yep.
that's kind of where my mind's at. Anything over than that, it starts to be like, well, is it the right? Do we do it? But I'm like,
Mhm.
sub 2
Well,
years. I'm
what
like,
I love is you also didn't extend their time period.
yeah,
Like a lot of loan officers will do, where, oh, well, they're 5 years into it and we're going to redo at 30.
yeah,
Well, you kept them at the exact same time period,
yep,
which that's when you look at it, that's a huge amount of interest savings for them as
mhm,
well. I know
yeah,
when I did my refinance, when rates dropped, I cut 8 years off my loan.
mhm,
And the amount of interest I saved was it was like gonna be $100,000 roughly.
mhm,
And I think that's some of the best advice you can give your clients
yeah,
as a lender is, hey, we don't want to actually extend you, but if we can keep you the same and actually save you $400 a month,
yeah,
that's awesome. That's I would have pulled that trigger. I would have
yeah.
pulled the trigger on that one. Definitely.
They're still thinking about it. So, but it's
Yep.
one of those where it's like you can only give them so much information. And that's the hard part is sometimes it makes sense. There might be some other factors that we're not thinking about that that I don't know. But in
Hmm.
that situation, it's not only like you're not adding more time, you're saving money. Like, so, and it's like, and you run the numbers with them. And I was like, well, what if we took that 400 savings? You just kept making the same payment because
Hmm.
you're comfortable with it and you paid that same payment. You don't have to. You can take the 400 and save it, or you can take that 400 and keep paying it. And they were going to pay off that loan almost, it was something like another 8.5 years earlier. So it's like
Wow.
effectively just by doing it, we eliminated, 8 years. Like I was just like, it's craziness, like all the different pieces that you can see and start playing with the X's and O's. And really looking and evaluating the puzzle pieces. But the key there is you have to pull the trigger.
Hmm.
And sometimes, bars aren't willing to, or consumers, because there is too much information. The media,
Yep. Yep.
you see, oh, rates are going to continue dropping. So the immediate assumption is like, all right, well, they're going to go even lower. But I'm sitting there and it's like, well, if as a consumer, what do you think the people that are figuring and factoring everything out know
Yep.
as
Yep.
well? Like,
Yep.
do you
Yep.
think that they're not looking and evaluating that data today?
Hmm.
I don't know.
Very true. Very true. Well, speaking of numbers, let's get into our Orlando numbers for the week. Um, I'm hoping this is our low spot. With the interest rates coming down, I'm
Mhm.
hoping this is the low spot for the year
Yeah.
because we dropped to 300. We had Labor Day, so we dropped to
Yep.
345 closings, which that's very low.
Mhm.
And we did see another small decrease in inventory, which was one, not as many new listings, but two, the um, continuation of people removing their listings,
Yeah.
saying, okay, we're just going to take it off. It's been on for too long.
Mhm.
Yeah. Condos, we dropped to 91. We saw that inventory decrease a little bit. That's wait till you see the number of months. Oh my gosh. But this is interesting because we hit that old school number that everyone talks about, 6 months worth of
Yep.
inventory. That is, quote, the declaration that it's a buyer's market.
Mhm.
And we hit that this past week, that we have 6 months worth of inventory. And then you see up 500,000 and above, basically we're almost up to 8 months worth of inventory.
Yeah.
And then we look at every week, which is the original list, the sales price percentage, and this got pushed down to
Mhm.
about 92%. Our days on market continues to stay very high at over 70 days on the market as well.
Yep.
And graphically, I mean, you kind of can see it's a continuous downward slope in the number of sales in
Yeah.
in Orlando. And I'm thinking over the next, well, it's going to take about 3 to 4 weeks before
Yeah.
we
It is
start seeing
September.
those numbers, you know, but hopefully, you know, buyers have a good loan officer like yourself, good mortgage broker, and is going to say no, and are going to be able to take advantage. Maybe they are closing next week, got a couple closing, if you got a couple closings next week, and you're able to pull them down on that interest rate a little bit and see, give them a nice surprise at the, hey, we're able to help you get down half a point and save you a little bit of money overall. I know that would make me feel great.
Yeah. I've got multiple clients that were doing that. Right now, we're doing what's known as a float down or whatnot. And the thing is like, it's a cool option because it's like we were able to protect your rate so you couldn't get worse. We saw the big improvement and we're able to take advantage of it.
That's great. That's awesome. Excuse me. Then we see our inventory slowly starting to creep down. Not a big difference, but a little bit of a difference overall. Mm-hmm. And then this is something I've been watching a lot lately, and that's the red line, which is your short sales. And look at the active number of short sales continually to grow.
Mm-hmm.
And there were a couple articles that I read this week about people who we've talked about before, been in their house 2-3 years, and having to get out and are putting their houses on the market, not selling, and their new sales price is actually below what they purchased the house for.
Yeah.
We're going to see some more of that, I think. I think the rates will help stabilize prices, but I don't think we're going to see a lot of it continue to see the growth that we have in the past.
Mm-hmm.
And then here you see it, why is the inventory shrinking? It's over 200 people withdrew their listings, last week alone. Yeah. Then here we go into the condos.
11 months.
11 months. Look at this in the under 250K. You have a year's worth of inventory right now.
Wow. Well, I'm looking. I see the 400 to 500K, which there's not a lot. Like it's hard, but 24 months of inventory.
24 months inventory.
2 years worth of inventory based off of sales volume.
Yep. That's just incredible. I mean, how do you wait 2 years to possibly to sell your unit?
Yeah.
That's just incredible. And then again, you see original list to sales price, sitting right around that 92%, and days on market 92. So overall, I'm hoping those are the worst numbers we see all year for Orlando. Yeah. I really am. I think with the rates coming down, I think I would love to see us get up to that 450, 500 mark in the next 3 or 4 weeks. I think there's a good opportunity for that to happen.
I agree.
So I think there's been, I know I've got a lot of clients who've been sitting patiently waiting for rates because you went through the numbers. That $200 a month makes a difference for them, whether they purchase or they don't purchase a house.
Mm-hmm. Yeah.
Yes, they fit their DTI. No, they don't. They don't have to go pay off some credit cards, in order to get their DTI under the limit that's been set.
Yeah.
So,
well, I think right now there's going to be a small window right now that you're going to see people win, and meaning you're going to benefit from the fact that there's less competition, that it's still kind of a buyer, but they're also going to benefit from the lower rates. Like, so they're going to be able to negotiate some seller concessions, get a good deal, but also get the better rate. But I think it's going to be short-lived because I think if the rates stay stable, you're going to get an influx of buyers finally coming off of the bench and saying, okay, I'm ready to go.
Yeah. It's when you start seeing the number of showings for your listings starting to increase, the sellers start to get more confident and start to feel like they don't have to give as much as far as concessions as where I've only had one showing this past week. Now I've had 6. Oh, good. We've got some competition again.
Yep.
I think that's what we're over the next couple of weeks we may start to see.
Yep.
So, like you said, there's a window there. Take advantage of it. Take advantage of it and run full bore while you still can. So,
Absolutely.
well, thank you. If you're on YouTube, Facebook, please like and subscribe and join us every week here at the Orlando Real Estate Buzz. Take care. Bye-bye.